What's going on? Money Morning Live. Nice to see all of you here. We have a packed house right now. That was a great show with Brandon and Nick. Brandon letting Nick do a few extra pew-pews there at the end. But right now we have Tom Gentile. He's coming in with Power Profit Trades. Talked a lot about crypto yesterday. Today we're flipping the script. Let's bring him in 5, 4, 3, 2.
Hey everybody, Tom Gentile here. Welcome to Tuesday, February 8th, Power Profit Trades, and this is our Operation Surge Strike edition. So we are talking all about stocks. We're talking about options. We did like Eric said, a lot on crypto yesterday, and Nick really came through, gave you guys some great information. But in the next hour, I want to talk about volatility. I want to talk about Under Armour. We covered that. We discussed it a little bit last week. We also want to talk about Mohawk. And I want to talk about Brutus. Brutus is not a stock. Brutus is my option software that I use to find these volatility trigger events. I'm also going to be taking charts by request, so get your charts ready in the chat room. And I got a lot to cover. Eric, we got a lot going on today before we head over to our Operation Surge Strike members only room at 1 o'clock. So, man, we got to get going here.
Yeah, we better get this moving. I popped up this screen because my colors were still off from the Kenny show, so you got a little double up of me. But yeah, we are going to get right into things. Take us into it. Where do you want to start, Tom?
Yeah, so let's start with the overall markets, and let's do a quick scan of what I like to call the 40,000 foot view. We're going to do a little bit of emphasis on the VIX today because that really starts out the volatility. So I could go backwards. But in this case, I think I'm just going to start right here with the S&P, with SPY. And as you can see here, a lot happened between, remember you guys, when we started even an hour ago, the markets for the most part were down. I mean, the only thing that was up was the Dow. Again, this is a very, very tricky market to navigate. And I mean, 1 minute you're down, next minute you're up. We saw the NASDAQ was down maybe about 0.5% this morning. Now it's up almost 1%. It went from being the worst performer to the best performer in 60 minutes. And, I've seen some changes. I'm a volatility seller right now overall, but I'm showing you how to be a buyer, okay? A buyer in volatility. And in this case, with volatility gets high, you know what I like to do? I like to step back, and I don't even need as big of positions as I normally get because volatility is advanced. So S&P started off today, down here around 446.73, but it's the last hour. We had a turnaround. There was a shift, and it could be very short term, a shift in momentum with the overall markets. Take a look at TLT. This one has got me concerned, okay? Because if we really had issues going on, if we were really being brought to the fire with Russia and Ukraine, which is kind of the story we're hearing right now. Eric, my mother-in-law, she's old school. I mean, she's old school and goes back to, back to the 40s, 50s. And, she was around when, when the Cold War was happening in the 80s, and they had moved from Italy to the U.S. And so my mother-in-law, and especially my wife, she says, boy, all my mother talked about was war back in the day. Well, she's at it again because, she sees the news on TV and gets spooked. And a lot of what's happening in the markets is a spooking. But this chart right here, this is pretty much a divergence from what's going on, because you would think if we really were on the cusp of being part of this war, this right here would be going up, all right? Because people would be buying bonds. They'd be getting into safety. But no, the bond market is now below 139, TLT below 139. It has not been at 139 in quite some time. We broke through the 140 resistance. We actually did that on Thursday. I really thought this was going to pop and turn around, but it's continuing to move down. We see the volatility now starting to continue to move up. So it's going to be very interesting to see whether this continues to momentum to the downside or have a turnaround. I think in order for it to turn around, Eric, we've got to see something a little bit more than us sanctioning Russia if they invade Ukraine. All right, so moves us to oil. Here's another one. Oil tends to go up when we get more and more involved in a conflict or a war. What's USO doing today? It's down. It's actually down off of the highs of 65. We're at 62.95, down about 4 or 5%, depending on how you look at it, based on yesterday's high. Another kind of interesting area where the markets are telling us something a little bit different than what you might be hearing on mainstream media. Take a look at gold. Now, gold is definitely moving in the direction that, typically when you look at conflict, you look at war, you're always going to see that's bullish for bonds, that's bullish for oil, and it's bullish for gold. And right now, we only see one of those three moving in an upward direction. All right, so GLD. We got GLD pegged at a low over the last couple of weeks, around 166.5. The high was 173. And we are trending back up to that 173 level. The one thing I've been noticing about gold, Eric, and I don't know if those of you watching me on Monday Morning Live or you're watching me on YouTube, I don't know if you're noticing this. Tell me what you think. But GLD seems to be taking the stairs, and then in 1 or 2 swift days, it takes the elevator back down. I wonder if that is going to happen again. I believe in order for that to happen, there's got to be some conflict resolution that happens between Russia and Ukraine. If that happens, expect GLD to be back down into the 160s and rather quickly. So that's GLD. Now, let's end with the VIX. And if we have a little bit of time, Eric, I want to go back to some FAANG stocks because that's where the volatility is right now, and at least 1 or 2 of them.
You got it.
So
Tom.
VIX is, VIX is down, but, it's still, it's cooling off. See these highs up here? And you might be looking at this and saying, wow, when the VIX goes higher, the volatility goes higher. The VIX is volatility. So these 2 lines, these candles and this red implied volatility line are going to move together. This is the only chart, one of the only charts where you'll see these 2 lines move lock and step together because one is a byproduct of the other. But we're even though we're off our highs, we're still up about 35% from Monday's close. Now, I had mentioned that we were going to more than likely get back down here. And it looks like that's the direction we're moving in. We're moving in to last week's low. We discussed that yesterday. Definitely looks like that's happening today. But an hour ago, if you would have asked me that, that's when we were up here. We were hitting those highs at 20 again. And around 2059 was the high. It was around 2050 when I was looking at it this morning. I thought, all right, this is going to be interesting. We might have an outside bar or an outside candle to the upside, and actually the reverse happened in the last 60 minutes. Back down to low. I expect to see this continue to drag on through the day, all right? But it isn't volatility on the overall market that we look at. It's volatility on data, on individual stocks. What's likely to make the market still volatile? Let's talk about those for a moment. We got inflation data still coming out this week, all right? We've got a lot of earnings, mostly on the retail side, still looking to come out this week and more importantly, next week. Of course, I covered it already, geopolitical concerns. That's a lot of what's keeping the market on edge. But when you look at things like the VIX and you look at things like the bond market, they seem to be talking up a different tale, like they've gone beyond the news that we're seeing on mainstream media. Let's look at some individual stocks. The most popular, okay? The popular crowd, most likely to succeed. Remember that, Eric?
Yes,
you
sir.
ever look back at those yearbooks? You look at the most likely to succeed.
Yeah.
You're like, whatever happened to that guy? Whatever happened to that girl?
I think I'm actually that guy. You're probably that guy too, Tom. But
no,
I wasn't voted for it in the yearbook.
I was not on that list.
I'm not saying you were on the list. I'm saying you probably were the one that has succeeded the most. Not that you were on the list. I wasn't on the list either. We're doing all right, though.
You know what? I mean, I got to think I'm above average.
Yeah, I think you are.
But I got to tell you, I have never gone. And shame on me, but I've never gone to a high school reunion. I've never gone to a college reunion. I have family and friends in the now, not in the past. And so it's kind of the way I trade. I don't look at my past. I only look at what I have on right now and what I got coming on going up in the future. And also Again, planning, executing, managing. And you should have all that stuff kind of down pat before you even put the trade on. I don't like to whine about what I did wrong or pat myself on the back about what I did right. Although I need to do that a little bit because it does teach us, doesn't it, folks? When you do something right, it teaches you, it reiterates when you did something right. If you were following your rules, wow, if I follow rules, this is what happens. And if you did something wrong, did you follow your rules? And if you did, that's fine. Then you did the trade exactly the way you were supposed to. And if you didn't, it should tell you, maybe I need to stick to my rules. Let's look at some stocks and let's see if we can look at rules-based trading on these. Here's Meta. We talked about Meta. You know, Meta was actually on the Surge Strike watch list. And the reason why is it wasn't a before earnings event, although we did talk about it last week. I said, hey, there might be a good one-day trade here where you could take a couple points out before earnings. And that actually ended up happening. We talked about it on this show. But after we had that big drop down, and everybody was holding their breath, Eric, and it was, where are we going to go after this? Are we going to fill this gap, or are we going to continue to run? And that next day told us the run was going to happen. And we were looking at this falling down into the 220 level, and look what we hit today, a low of 219.77. Rules work. Let's take a look at Apple. Apple really, I mean, you had that jump in earnings, all right? You had that jump in earnings, and we actually had a let's look and see if we actually had a surge strike. We did not. There was not a real big surge in Apple. When you look at Apple, it just wasn't there. It wasn't like a big rush of money coming in. It's what it was expected to happen. They were expected to beat earnings. They were expected to go up a little bit, and they did, and they've kind of flattened out and gone sideways, but no real system there. Let's take a look at Amazon. Amazon had a big jump, okay? Now, what's kind of happened with Amazon? You got a pop from the day before earnings to the day after earnings, right? We didn't really have a surge strike before in Amazon. And if you take a look here, all right, you got your average volume down here around 5 million, maybe a little less. Let's call it 4. Average 4, and it popped to 12, right? That qualifies as a surge strike, a big surge. Now, you look at Amazon, and Amazon looks to have what I like to call bullish momentum. All right, so why didn't we have that as part of Operation Surge Strike? Because it's too expensive. It's too expensive. All right. And so, and also there was another area that our Surge Strike members might follow, and that is the width in terms of risk to reward. Just didn't look good on this particular trade. So that's why we sat that out. Netflix really didn't have anything to come through. So we're going to skip that. Google. Now, Google has had a very, very interesting move. It had a pop last week, and it jumped up, and we went from 2750 all the way above 3,000. All right, now let's look down at the volume. Look at the volume, average volume, about 2 million shares a day. This jumped to 6. This was definitely a surge strike. But again, here's one that's a little bit out of our wheelhouse in terms of expensive too. But look what they did with Google. It popped, and the next day we had the drop, which is telling us that they're going to fill the gap. All right, we talked about this also, about this gap potentially being filled. There's your day before earnings, 2750. Look what happened today. 2740. So it filled that gap. It only took 4 days, Eric, to fill the gap the day after earnings. So that's Google. How about Tesla? So Tesla just, really didn't have any. I mean, it had a surge coming in, but it wasn't enough to warrant any type of a trade. Now we're going to talk about trades that did warrant potential before earnings events, and I got one for you by the end of this broadcast today that we looked at last week. And last week it was a setup. This week it's become an opportunity. In fact, it became an opportunity today. So when we get to the top trade idea I have, Eric, it's going to be a surge strike trade. It's going to be a after surge trade. And I'm going to show you what to look for and what to plan for this particular stock. But what I want to talk about right now is individual stocks that we did discuss last week that were on our Operation Surge Strike watch list. Okay. So over the weekend, I don't know if you guys read any of the material I put out there. Okay. There's a lot of stuff that comes out through our publisher, but looking and sifting through the reports that we send out, I put out an article over the weekend, and I talked about earnings again this week. And I talked about two companies, Eric. One of them was Mohawk Industries, and the other was Under Armour. And those were two that we were looking at on Operation Surge Strike, and that was our watch list. Actually, last week, not just at the beginning of this week, we were looking at it. In order for me to look at something, it had to have already been on my list. By the time our publisher got it out during the weekend, we'd already been looking at it for a couple of days. So I want to share with everybody those two stocks, and I want to intertwine with those two stocks a straddle. Because didn't we talk about straddles last week, Eric?
I believe we did. Can't 100% say that I understand what you're talking about with them, Tom, but I'm sure the chat's following along better than I am.
So
I'm learning.
What we'll do then is this. For the next, let's call it 10 minutes or so, I want to take those two top earnings picks that we were looking at last week, and I want to merge them with the strategy session we did last week, which is a straddle. And let's just see what's going on. Now, in order to do that, I need to talk a little bit about volatility one more time. All right, so let's talk about volatility one more time. And we're talking about a couple of different types of volatility. You guys remember, I talk about this every week. The tide rolls in, the tide rolls out. Now, the tide rolling in means that we like to jump ahead of the herd, the crowd, the mainstream group of traders. I like to call them the 99%. Okay, because 99% of traders out there do not trade this way. They do not look at getting in before everybody starts talking about it and getting out when everybody starts talking about it. And that's what taking the surge, that tide rolling in. So the tide rolls in as we're looking at 1 to 2 weeks before earnings, before everybody starts putting it on the list, before CNBC, Fox News, the big guys start talking about these earnings, and then alerting everybody to it. When they alert everybody, that's when we want to be ready to get out. Before then, we want to get in. We want to quietly get in and try to grab some percentage move. And you can do that by looking at patterns. Did the stock go up the last 4 earnings cycles before earnings? Did the stock go down the last 4 earnings cycles? Or was it wishy-washy? Because a lot of times when you're predicting price, and Eric, I'm talking to you. When you predict price going into earnings, it could be anybody's guess. I mean, look at what happened to FAANG last week. Just a couple of the FAANG stocks. We saw Google surprise and go up while the market was going down. We saw Facebook/Meta. That shocked a lot of people when it dropped 25% one day. We have not seen a move like that since 2018 coming out of earnings. So you look at those, and those are surprises. Like, for instance, this stock had an earnings increase, and it dropped from a close of 70 to a close of 50. That's a big drop. Then here we had an earnings that came out, and it jumped up, and the earnings were good. Here we had the earnings come out. We had a little bit of a jump. So, a lot of times it's hard to predict stocks going through earnings. I like to call it a gamble. If you're going to ride through earnings, you really are taking the volatility risk. It's kind of like a rogue wave. A rogue wave is a wave you don't see. If you're in the ocean, and, Eric, I'm kind of getting into this idea that, trying to talk my wife into this.
What are you trying to do?
I want to get a boat. Okay, we'll call it a ship. Something a little bit big, and I want it to be able to carve through waves offshore. Mm-hmm. She has no interest in this at all.
Man, you're not talking about a pontoon boat here.
Waves I hear about. And so I started looking at some of this stuff. I'm like, what is a rogue wave? What truly is a rogue wave? It's not just wave that comes out of anywhere. It's two waves where the front wave is going slower than the back wave, and then the back wave jumps on top of it and actually doubles in size and magnitude. And there, you see some big ships, even Coast Guard ships, that actually almost hit a 45-degree angle when they hit these waves. Now, What has this got to do with the stock market? Buying into earnings with a lot of stocks that are popular stocks. If you're trying to buy and go through earnings, you could be going through rogue waves. What happens in earnings statistically? Statistically, you're going to lose more than 2 out of 3 times. And depending on how much you pay on those options, it could be a lot more, right? So why not, instead of trying to predict price, predict implied volatility? Because it's so much easier. It's so much easier. You can, and this is what I do. I go out there. I mean, how many optionable stocks are out there that I follow? I mean, there's thousands, but I follow a little bit north of 300. Of those 300 stocks, we have 4 events per stock per year. So right there is 1,200. Add on a couple hundred more, and you're talking about 1,400 to 1,500 events that could happen in the group of stocks that I look at. And it isn't just earnings. There are other things that happen, like FDA announcements. All right, there are other planned events that we can look at and look at these, what I like to call rogue waves. Look at this thing, up to earnings and down. This is not the price of the stock. This is the option traders bidding up the prices of options. And what we do is we take all those prices of options each day. We timestamp them, and then we kind of turn them around through an option pricing model. And we're able to get a percentage of the projected move. That's what's called implied volatility. So we have this percentage, and you can see the percentage move on this particular stock went from below 96 to above 166 in a matter of a couple of weeks, about a week. And then in literally within a couple of days, it dropped right back down. Before earnings up, after earnings down. Now, it doesn't happen with the magnitude of this size on every stock. There are some stocks out there that do this, and there are some that don't. I scan with our software to find these stocks. Up, down, up, down. It's like calisthenics, right? We like to find the stocks that have the biggest up, down events. Now, I mentioned 2 last week, Mohawk and Under Armour. Let's take a look at each of those and see how they turn out. So if you take a look at Mohawk for a moment, now I've got these all set up so that I'm not messing around and wasting time. See what happened to Mohawk? The price is going down. Okay, price could go up, price could go down, and price could go sideways. But look at what's going on with this option as we're getting into earnings. Most importantly, look what happened in the last week. Earnings are in 2 days. The stock went from 150 to about that 155-ish, a little bit higher, and then back down to 150. All right, great. At the time that we were looking at this, we were looking at that 160 call and 160 put, right? This is February 18th because these are the closest options in February that we have to today that actually go through earnings, right? So the Feb 18 options. So if you look at the Feb 18 options on Mohawk, you're paying $620 for the calls, you're paying $760 for the puts. So if you put that together, that's an option that's going to cost you about a little more than $13 or $1,300 for the trade, $1,380 to be exact. This is a straddle, the call and the put. And what this means is if the stock goes up, the calls will outpace the puts. If the stock goes down, the puts will outpace the calls. But here's what every straddle trader will tell you. If you don't believe the stock's going to run really hard one way or another, this is a losing situation. And I agree with them, except before earnings. Because before earnings, what happens is your time doesn't, in a lot of cases, your time value doesn't go down. It stays sideways or it even goes up. Look what's happened to this trade. The stock's gone down a little bit. In the last 3 or 4 days, we've seen the stock drop about 7 or 8 points. So where are we on the trade? We're out here on this end, so the puts are outpacing the calls. But you know what else is happening? The implied volatility has increased. So this $1,380 position is actually up about 10%. Stock hasn't moved that much, okay? But what's going on is more and more option traders are coming in, buying those calls because they think Mohawk's going to go up after earnings, buying those puts because they think Mohawk's going to go down after earnings. This is what we profit on. We profit on scalping this particular trade, right? So when do you get out? You get out before the earnings announcement. If the earnings announcement is in 2 days, let's go back and look at the chart. On 210, you want to be out before earnings. You want to be out before 210. Let's rinse and repeat the strategy one more time with Under Armour. So Under Armour is a stock that's trading well below Mohawk. I mean, this is a $20 stock. So guess what? The Straddle is going to be cheaper. So at the time, we were looking at about 19. Last week was around $19. Just a couple days ago, $19. So what are the 19 Straddles going for? The 19, and this one again, let me back up and look at that chart one more time. Earnings are in 3 days. They're on 2/11, estimated February 11th. So we want the options that expire either at or just after that. We don't want the options expiring before the earnings because you won't be able to take advantage of this volatility surge. So I pick options that expire on or before. In this case, the Under Armour options are they expire on Friday. So what happens is Under Armour is going to give everyone their earnings before the market opens on Friday. So this is the one that if you want to be in, you got to be out Thursday because you can't be out on a Friday. By the time you get out on Friday, the news has already come out. You want to be out before they announce the earnings. So here we are. This is last week. 1908 was the close. So the 19 calls, Eric, cost $1.09 right in the middle. The 19 puts, $1. So for $2.09, you're putting on an at-the-money call and an at-the-money put, and you're creating that V-shaped trade. You don't care where the stock goes. And in fact, even if the stock goes $1 up or $1 down, it doesn't matter with this trade because we are looking for the implied volatility. We're looking for those option traders to rush in, buy those calls, buy those puts. So what has happened as we've gotten closer to earnings? Here's what's happened with that straddle. That $209 straddle is up 18% coming into this morning. 18.2%. Well, what's going on with the trade? The $1.09 is now $1.56 by $1.62. The dollar is 86 by 90. So the puts have lost a little bit of money, but not much. But look at what the calls have done. The calls have gone up over 50%. So between the two of them, again, it's not about the calls or the puts in this case. If you buy the straddle, it's about how much the entire straddle costs. You put this on as one ticket, you take it off as one ticket. It's that simple. So, those are the two we talked about last week. Those are the two I wrote about coming into the weekend. And that's why Mohawk and Under Armour were at the top of my watch list. So that's kind of the earnings lineup. I've got a couple other ones I want to talk about with you as well. But what I want to do now is I want to talk about how we play these once again as an option buyer. So Eric, what do you say?
Yeah, I think we should jump into the Surge Strike software because I even saw some people in the chat asking about Brutus. They were asking if what you were just looking at was Brutus. So I know that you're going to talk a bit about Brutus right here when we talk about this software.
Yeah. So, take you back to grade school. If you're running around if you're a new kid in school, all right, I was a new kid in school every year or two. All right. Let me tell you why. Because my father was in the Army. So I was an Army brat. Then he got into civil engineering because he went from one government job to another. And we moved around a lot as a family. I mean, that I've been everywhere, man. I have been everywhere, man. I was a professional new kid in school. That's what I called myself because every year I was going to a different school. So I didn't make a lot of friends in school. And the reason why is because I knew we were going to be moving again. Therefore, I was the new kid all the time. It would have been great, Eric, to have a big guy named Brutus kind of watching my back.
It's always nice to have a Brutus having your back. It seems like you do now, though, right? In a different context.
I have a Brutus.
Yeah.
I have a Brutus. He watches my back. He tells me what to do. And then I just kind of vet the signals and go forward. And that's what we look for. I mean, we're in the thick of earnings season right now. And we've probably got about another maybe 2 weeks. And then Brutus is not going to take a little vacation. He's just going to go from full-time, from working overtime to working more part-time. We'll get signals, once or twice a week, but not a couple signals a day like we've been getting. So, I've talked about Brutus before. This is my custom artificial intelligence, and it's designed to uncover what we call trigger events. So trigger events are anything that launches traders into an absolute frenzy, okay? And what does? You know what? It's the trigger event, but you know what launches people into a frenzy? It's listening to mainstream media, because these guys are my best advertisers. I couldn't pay to have better advertising than we get from mainstream media about earnings, about what's on tap. Because what it does is it just takes something that wasn't in a trader's brain, it puts it in their brain, and they start thinking about it and think, I need to buy that. I already want to be in that when that happens. So Brutus identifies that trigger event. That's the event that's going to trigger people to start speculating, okay? And so we go through a couple of different things. We have what's called the initiation point. And the initiation point is a place where we know that's the time to get in. That's that sweet spot before everybody knows the event's coming. It gives us an idea, an advance warning of how far the trigger event's going to happen, and where we have the surge, where the surge is going to likely begin. Now, this is important because, again, it tells us where we need to position our trade. We want to get in ahead of the speculation. The next thing Brutus does is it identifies something called magnitude. Magnitude is how far that initiation point is likely to happen. So, when I looked back, and I was looking back at, wasn't Tesla. When I was looking back at, let's see if I can find it here. All right, here's Under Armour. So with Under Armour, let's look at the chart of Under Armour. So what Brutus was doing was right down here, it's seeing that initiation point. And that initiation point was happening back down here at 19. Now, if we took away these 5 days, let's do that, because I have the ability to go back and do that. So let's take ourselves back to Wednesday of last week. All right, here you go. There's Under Armour. Okay, here's the pop up the day after 19. And it shows you what was really happening was Brutus was now, we had that run up, and that was a lot because of the stock was dropping. But this latest run up is happening because guess what? Earnings are coming. And that's what we saw, that spike up. And Brutus says, guess what? Got your initiation point. Now, what Brutus will also do is it will go back and it will take a look at what happened in these previous moves between initiation point and termination point, and that's called magnitude. It gets that average move up, and it gives us an average that we should expect for return on investment, okay? Return on investment for calls if we're bullish, return on investment for puts if we're bearish, return on investment for straddles if we're going to take both sides. Now, a straddle is always going to have less return on investment than a call or a put. Why? Costs twice as much, and you're only going to get about half the move. So you got to keep that in mind, right? If you want to trade regardless of price, you got to be willing to take a little less when it comes to profits. Now, the final thing we look for is that termination point. And termination point, guess where that is? Right here. So the day of earnings, we want to be out the day before earnings in many of these cases. But Brutus will determine, based on past history, whether that event, whether it's time to get out the day before, maybe 2 days before, maybe it sees the crest happening 2 days before earnings. All right. So that's the way we find these trades. This strategy has been working extremely well. I mean, if you look at the first month of 2022, showed you this last time we were together. All right. Let's set that up, because I want to also do the what have you done for me lately part. Okay. So that's what this strategy session's going to be brought to you by today, Eric, is what have you done for me lately?
I like it.
Okay. January, Operation Surge Strike. We had 11 trades in January. We had 10 winners. So that's an 83% success rate. We had a 70% return on investment as far as unweighted returns. What's an unweighted return? An unweighted return is if you take the single contract, the smallest dose of getting into the market as possible. So that's one contract, no matter what it costs, no matter what it did. So To me, that's for me, that's not the way I trade or invest. I like to take a particular number. Maybe it's $500, maybe it's $1,000, maybe it's $5,000. And I like to trade each strategy dollar cost average. So if we were to dollar cost average this and we went to more of a weighted return where it's weighted by dollar, this actually gets better, right? But I want to show it to you as an unweighted return. So what we can do is let's go ahead and talk about, Eric, and we're going to throw some images up on the screen because I want to show everybody how to use the Brutus software and how we use it to actually drill down the timing of these earnings events.
Yeah, that sounds good, Tom. Are you ready to get into this now? Because
let's go. Yeah, let's start with global payments because that's a good one. Because I really want to show people what's been happening in the first week of February. Because I mean, we've got another week under our belt. So let's look at global payments and let's talk about how the software shows me how the stock tends to have, in this case, strong downward moves into earnings over the last couple of reports. And so that's what you're looking at, folks. What you're looking at there is you're looking at Brutus, but you're looking at it in chart form. All right. Now I get all the data. I actually get the surge strikes. I get it out in tabular format. But you can see it right here. This is global payments. GPN is the symbol. And as you can see, a couple things were going on. We saw earnings. Now look at the prices. The prices were moving sideways to down. All right, in this case. So sideways to down. And what you're seeing here are just the last two sessions with earnings. Now, couple things that we looked at. We had that initiation point, and that initiation point was the day that chart popped up. Okay, 8 days before earnings, we had that initiation point. The magnitude, that's the surge projection. Okay, and that shows us that we're projected to see IV rise by an average of 27%, and we're looking for a 92% move on the actual trade we're looking at doing, which in this case was puts. So you can see here, past two earnings, buying puts on GPN 8 days before earnings produced an average of 92% ROI. So guess what we're looking at doing when we went into this one? By the way, we did this one. This was our Operation Surge Strike, one of our alerts that went out. So we took advantage of buying these puts on global payments. Now, when you buy a put option, you already know, at least you should know two things. Number one, you're betting that the stock's going down in price, okay? But here's the other part when you do it with Brutus. Brutus says, not only are we looking to potentially go down in price, but we're looking for a cascading of people falling over themselves, tripping over themselves to get short by means of buying puts. And they're going to get short by doing that after we're already in. Now, how do you get short buying puts? By buying puts to open. We want to get in before the surge strike, and then the surge is happening. And you can see this because as of last night, the puts were up in price by 50%. So our entry price on this trade was $5.20. Last night, we clocked it in for $7.80. That's a 50% return. And then look what happened today. So today, this was last night, was 50%. Today, boom, goes the dynamite. We got a hit. And we had a 100% profit target that was hit this morning. So what do? We send out an alert telling everybody, but they already should have known. Though, if you set this up correctly, you would have woken up, even if you woke up late. You got a ding on your phone, and the ding on your phone would have been your broker saying you sold to close at the limit order of 100%, that $10.75 or better. But we send that out to you anyway. We send that alert out to you, letting you know this doubled in profit, and here's what to do. We gave you the entire action to take. So there you go. Now, Eric.
Yes, sir.
This doesn't just work with puts. Okay, we scan opportunities on calls. We find more. I mean, if you go back and you look at Operation Surge Strike since we started it, I would imagine that when we're doing it, if we're looking at just calls to puts in terms of alerts, it's probably 2, maybe 3 to 1 in terms of calls to puts. And that's not because we think the market's going up, guys. We don't think. Okay. I mean, here's another one. How many times have my wife has told me in the last week, you know what, baby? Because that's what she says to me. You don't think. I don't think before. Before what? You don't think before you buy me a flat screen TV. Wouldn't you have wanted to talk to me about it? We're having this, so we put she wanted a bigger TV in our condo. All right, so we have a condo downtown, and the TV is too small. She wanted a bigger TV, so I surprised her. Okay, buy a nice big flat screen TV. Got it. I mean, how much you could be blind and you could see an 85-inch television 15 feet from the couch to the wall. And I got this one called the Frame, which is a really cool television because when it's off, it looks like a piece of art. Anyway, I mean, she says to me, she looks at me, she goes, "Huh? So you got me this TV?" I said, "Yeah, you like it?" She goes, you could have consulted me on the TV. You don't think, do you?" Well, when it comes to trading, I don't think either. Okay, I let Brutus do the thinking. I do the trading. And Brutus tells us that in the past, we've had more call opportunities than put. The common denominator here is whether it's calls, puts, or straddles, it's the IV that is the most important piece when we're putting together surge strikes. So we have built proprietary software to help us find these potentially higher probability trades, higher volatility trades that give us these in this case, these fixed risk, high reward trading strategies. Let me show you one more. So Eric, bring up that image on Robinhood. Probably one of the most hated stocks out there. It is absolutely amazing. I said this about Meta last week. I'm going to say it about Robinhood this week. How interesting is it that just 2 years ago, everybody loved this company? I mean, they just wanted to be a part of it. All right. The meme traders loved it. Millennials loved it. Gen Y, Gen Z, A, B, C, D, E, F, G. Everybody loved Robinhood. Great, beautiful look on the phone. They loved the way that when they place a trade, it was like a congratulation, boom, popping, all kinds of graphics and stuff. Everyone loved that. Now everybody hates it because of one event with Citadel, which I won't get into. Anyway, look at the stock. All right. Stock was, and the chart that I'm showing you is a chart of the stock that went from $19 not that long ago down to 10. I mean, this thing, and that was after it was even higher. I'm just showing you what happened on the chart in the last, 30 days. The stock's dropped almost at half in the last 30 days. All right. We had a surge strike happening on this one. We had a volume spike that happened. This is an after surge event that happened. All right. Robinhood broke above Friday's high. It signaled a bullish surge strike opportunity. Okay, I'm going to read this to you. Surge strike expects the stock to move up to about 16. With the options expensive, we'll be employing a bull put spread. Now, there are times where we will take advantage of the high side of volatility. Okay. Again, with global payments, we took advantage of buying put options as they rose in value. Robinhood's options got so expensive you did not want to buy them. But when the surge strike came, it gave us the opportunity to sell that high, expensive option premium to somebody who was tripping over themselves to buy it. And what we did was just simply hedge that risk by buying some protection. That's what a bull put spread is. Okay. So we took that trade off for a profit as well last week, Eric. That was riding out the tide. The tide goes in with global payments, and the tide went out with Robinhood.
So what's going on this week then, Tom?
We do a lot of straddles, but I want to show you how we get into not only a rising surge, but a falling surge as well.
So what's happening this week? You were saying that was from last week, right? So do we have anything that was going on this week on the charts currently?
I do. So a last week and this week situation. So let's look at that. So let me move over here. Let me show you. Okay, last week we talked about UPS. You guys remember UPS? All right, let's zoom into. Okay, here's UPS. On the low side, it was 200, and then the earnings came out. And it popped up here to around the we're going to call it 222 to 232. Now I'm saying that because I want to zoom in here so everybody can get a good look at this. 222 to 232. Now we were looking for an after surge event because we didn't get anything before. We didn't see a surge that made sense. Brutus didn't tell me about one, but Brutus was telling me last week, hey, keep your eyes on UPS because if it goes higher than the day of earnings, we want to potentially look at buying call options or a call spread. If it goes lower and it pierces this low anytime, we want to look at potentially buying puts or doing put spreads. All right. Well, guess what happened yesterday? We dropped down below that low. This is informing us that we could have a potential option trade on UPS to the downside. How far down are we expecting this to go? Well, if we drop down, we can look right here. I've got a dotted line here. This is what we call stock chart peaks high. And this is what we call our stock chart peaks last resistance. So, you know, the old saying, if you're a technician, is that support can sometimes become resistance and resistance can sometimes become support. So we're looking at this old resistance line over here, and we're going to look at that as a potential support point. So we see a potential one-to-one opportunity here. Now, one-to-one means price-wise. If I were to short UPS, then I would look for UPS to drop down from this level here. Let me back this up so we can talk about price again. We're at 224.47. All right. We're looking for this to go down to around the 218 level. So you're really looking at about potentially 6 points down, but you got about 6 points of risk to the upside. So that's what we call a one-to-one reward to risk ratio. And in terms of options, we can look at options to see if we can get at least that, but hopefully more. All right, let's do that then. So in this case, I'm going to go to an option chain on UPS. And I want to look at UPS options, and I do not want to look at options that expire in 3 days or 10 days or 17 days or even 24. I mean, let's go out and look at the March 18 options. This might be going out a good bit, but you know, when it comes to these after surge strikes, they can take up to around 30 days on average, right? The before surges, we see those happening 7 to 14 days, depending on the stock and depending on the pattern. After surges can take a little bit longer. So let's go ahead and update this. And I'm going to look at those March options. Now I need to look a little bit farther out. So let's go out about 20%. Because again, looking at that stock, I want to make sure I give myself enough room, but not a whole lot. So the stock's at 225.71 right now. If we're bearish on this trade and we're looking for about a 6-point move, right? Then what we'd be looking at is 225, 71 to go to 220. So if 6 points is the minimum, what we're looking for, we could buy the 220s, but the problem with the 220s are that if you buy that 220, it's going to cost you about $5, right? But if I'm going to get 6 points in a $5 move, I might only spend $5 and make $1. I don't want to do that. So what we could do is we could try to finance that by selling. We could sell a lower strike put. So now if I buy the 220 and sell the 210, this is an idea. I want you guys to go out and create your own bearish trade on UPS. But this is an example of a trade that's going to cost $2.66 to make potentially $7.40 in a move down, right? So that is a nearly 3-to-1, or excuse me, a 2-to-1. 3-to-1 reward to risk ratio. All right, you risk 260, you make potentially 740. That's 284% reward to risk ratio. Okay. Now, if you really want to see what we're doing on Operation Surge Strike, then number one, you got to be a member, be a premium member. And number two, if you're a lifetime member, then you're going to get even more benefits. But, we give you those alerts exactly when we see them. Sometimes they come out in the morning. Sometimes they come out in the afternoon. All right. It's really determining on when Brutus tells us there's something available, then we do a quick vet. Then we send all that research to Money Map Press, the publisher, who in turn gets that out to you as fast as possible. So that's what you see. We do that with, and when we put those in, Eric, we put those in as as alerts, which means that on those alerts, you get to buy and you get to sell immediately. So you already know what to do. So if I were just kind of show everybody, I know this has been, you guys should have the order form on your screen for those of you that are interested, right? Here's the order form. I'm going to walk you through it real quick. And I'm not going to read this to you because we don't have time. What I want to talk about here is you'll find that information on Brutus that we discussed here during the show. You'll find the track record that we have that we're showing, and this is the 2022 closed recommendations, which includes the February trades. All right. You can see I talk a little bit about what we do with Surge Strike and what you get. All right. We have a video course that talks about volatility and volume and how we use them and how Brutus uses them to find these opportunities. All right. We talk about the briefings. We get an average of about 2 of these a week. Now, when I say average, all right, what I mean is during these surge strike, the area that we're in right now, the sweet spot we're in, we're getting a lot more than 2. In between sweet spots, we'll get an average of 1 a week. But I'm just throwing that out there to you. So if you take a look at what we did, for instance, in January, we had 11 trades. That was nearly 3 a week. All right. And we didn't get started really until about the first week of January we had nothing. So in the 3 weeks following in January, we had 11 trades come out. So that was a big move. Right. And again, we talk about what you get. You get the entry date, the exit date, projected gain. But if Brutus makes a move before then, we'll let you know. Okay. Text alerts. Somebody was asking about this yesterday, about text alerts. And in order to get text alerts, you got to get a hold of my VIP team and let them know you want to receive texts. Okay. Then what will happen is you'll get a text alert to your phone. So you don't have to be sitting in front of the computer the whole time. All right. Surge Strike Arena, we do that at 1 o'clock. So we'll be back on at 1 o'clock talking about, again, myself and my research team, which is Mike Wade's the head of research. So I come in, Mike comes in, and we talk about what's going on. We talk about how the track record is looking. We talk about the open positions. We talk about the watch list. Is there anything on the watch list before earnings or after earnings? And so these are the things we cover. And here's the other thing. The thing we can do, the thing that we actually do in the room that we can't do in a big room like we have here at Monday Morning Live or on our YouTube channel is we can't go into into all your questions, okay? But we handle as many questions as we possibly can in our Surge Strike Arena because the room is much smaller, because the membership is smaller, right? So if you want any of this, which also comes with a money-back guarantee, read the entire thing, and then down at the bottom, this is where you put your information in. Once our publisher receives this, you will be instantly activated. And in fact, if you do it right now, I'll see you around 1 o'clock. So before we finish up today, Eric, you got any charts you want me to analyze to see any upcoming earnings or surge strikes before or after? From the group?
I do. We've had a couple of things come throughout the show. I've been grabbing some of them. We have this one asking if you could comment on Ford and on Netflix of what's maybe going on around there.
So Netflix we looked at already, but I mean, I'm going to bring that up again. Oh, yeah. No, you know what? I breezed through Netflix very, very quickly. So let's look at it. NFLX. And so, again, you had the surge has already gone. And as you can see, the surge is actually winding down. Netflix is consolidating right now. So to me, I mean, I don't have a surge strike on it. I don't even have a technical move on it. I just have support and resistance where we've got the support line. If you take a look at what we call real support. Real support isn't the stabs that you see here, okay? Real support is a combination of various closes. We got real support down here in the low 360s for Netflix. We got the resistance way up here above 500, so it's close to 510. But other than that, it's just kind of meandering on. For Ford, let's take a look at Ford real quick. And Ford just had its earnings announcement. I mean, talk about buy the rumor and sell the news. Everybody was so hot on this stock because it was all about EV, EV, EV. Okay. So, what goes up must come down. And that's exactly what happened with Ford, as going from a $25 stock to now trading at $17.42. This one took it on the chin very quickly. The earnings they missed. They were an earnings miss. A lot of people didn't expect that. That's why you saw it go from 20 to 18, and it dropped a good 10% after earnings, and that was already after a double-digit drop before earnings. Let's come down and take a look at Ford one more time. Not a big surge on this one. The average was about 100 million shares a day. So when you bring 200 million shares in coming out, that wasn't a real panic. That wasn't a real panic like it was with Facebook. So therefore, we didn't see anything, any move from that. We've got a free fall going on potentially with Ford. And the reason why is because I don't see any dotted lines below this. So the only area I can look to is really, looking at the gap that happened and looking at the magnitude of that gap. And we, and really like 16.5 might be the technical low, but that's just an eyeball right there. And I don't like guessing. It's just one thing I don't like to do, Eric, is go out there and guess.
Let's take a look at this one. We have AMC, Captain Wetbeard so nicely asked to see. We could probably get a couple more. We have a few minutes, so keep them coming in the chat.
Yeah, okay, AMC. Let's take a look at AMC. And if you look here, AMC has got earnings in 29 days. I mean, this was a memer going up. And, this is, again, a buy the rumor, sell the news event. The event you don't see on here is going back to the movies. The event you see here is that AMC has a blockbuster on their hands with Spider-Man, okay, No Way Home. And No Way Home has become No Way Higher for this particular move here, because after the event we've gone from 30 roughly down to around the 14 area. Here's the good news, if I have any to share about AMC. We're hitting dotted line support, stock chart peak support. We've come off that for the last 4 days in a row, so potentially we could see some short covering here, but not on Brutus, not on Brutus at all. What else you got for me, Eric?
We got Dave in PA asking about PLTR.
PLTR, and that is Planeteer. All right. And Planeteer, earnings in 9 days. Okay, let's take a look and see if there's a surge strike happening. There is not, because look what's happened. We rose up as Planeteer came down. Planeteer's been kind of bumping along here on the bottom. And you can see here, the surge actually fell off after we really kind of found that kind of bottom line support resistance area. It would have to get above, we'd have to see the implied volatility get above 100 before I'd get excited about this one. And it may happen, but as of right now, I just don't see anything there other than some hard line support now coming in before earnings around that 12.5 area. Anything else, Eric?
Yeah, let's do one more. I think we have time for one more, and this one's from SS, and they say it's not a flashy stock, but a retirement stock. What are your thoughts on ORLY?
ORLY. All right. O'Reilly Automotive. Earnings in 1 day. Look at this. It has gotten a surge happening to it, but if I come down and take a look, volume's kind of steady. It hasn't been rising during the surge. The surge has been happening really because of what happened the last 3 days, which is price dropping. But I would go back and look and see, did this price go up over the last couple of earnings announcements? Has that happened? And again, if it has, potentially a call opportunity here if you've got some liquidity in those options. All right. So that is it for us for today. Eric, thank you very much for being on the other side of the Mason-Dixon line.
Of
and
course.
We'll see everybody tomorrow, same time, same channel, as we continue getting into surge strike. And we'll talk about more of what's going on with UPS and how to trade these post surges. Thanks, everybody. Have a great rest of your day. We'll see you soon.
And remember, we're going to be in that Operation Surge Strike room in 30 minutes. So if any of you want to join us, that number's been up on the screen. It's in the chat. Come join us over there. See you, Tom.
Absolutely. See you,
guys.
See you guys. See you then.